It's the beginning of June, and you know what that means. May numbers are out for the Denver real estate market. We're going to take a look, do a little bit of a deep dive, find out what's actually going on in our real estate market. We're going to avoid all the headlines out there because you know what? They're months behind anyways, and we always know that. But what are prices actually doing? Are we on the uptrend? Are we on the downtrend? Is this just cyclical behavior? How many listings are coming on the market? Are there foreclosure issues? What is actually going on? Welcome back. My name's Alex Saldana. I've been answering questions for homeowners, buyers, and investors since 2010. And if you're new here, consider subscribing to this channel, and we're going to get right into the numbers. The first thing everybody wants to know is what prices are doing. So we're looking at a chart here of closed prices. This is the median price, not the average price, because depending on what you want to do, you can kind of fudge with the numbers. So we can see January was the low, $520 for the median sales price in the Denver entire metro MLS area. This is not just Denver proper. So we were at $520 and now we're up to $570. So we're up 10%, just about 9% since the end of January, which no one thought was going to happen. Heck, me included. Did not think we were going to take that extreme of a bounce. Last month we were at $558. This month we're at $570. So we're up just another $10,000 per sold property. Now, if we look at the average, let's see what's going on here. Similar numbers, 624 was the average at the end of January, and now we're up to 675. So not as much of an increase on the average price versus the median price. But either way, both prices are down from where they were a year ago. So going back to the median close price, we're at $570. Last May, we were at $590. So that's what the headlines are going to say is, hey, we're down in price year over year by, I think, 2.5%, 3%, something like that. But overall, this was a big dip. We dropped by about 15%. Now we're up about 10%. New listings, what's driving this price action? And it all has to do with simple supply and demand on the inventory. People are not putting their houses up for sale. If you're in an interest rate at, let's say, 3%, and you want to do the typical move up buy where you're living in 1,000 to 1,500 square foot house and you want to get a 2,000 to 2,500 square foot house, even if you're looking at the same price range because you're moving from the heart of Denver so you can get 500,000-600,000 for your place, and you're moving further out to the suburbs so you can spend 600,000 on a good sized place, your mortgage payment is more than double. So a lot of people are seeing that going, I'm going to get the same amount of house, dollar for dollar wise, but at the end of the day, I'm going to be paying twice as much on my monthly mortgage. So a lot of people are just sitting on the sidelines going, you know what? We're going to stay put for a little while. But this is what the new listings have done. So last month, as you know, we had a dip in inventory, which is extremely out of the ordinary to have a decline in inventory anywhere from January up until about May, June. It's always a straight line up. But we had a little bit of a dip, and it had me worried that we were actually going to have less inventory this month than we did last month. However, last month we had 7,400 properties come on the market. This month had 8,300. So getting back to a little bit more normal. We'll see what June has to say about it. Now, last year, for example, let's see where we were at. We had 10,300 new units hit the market. So 20% less inventory hitting the market today than 12 months ago. The amount of active listings. All right. So this is where we're going a little bit goofy. Normally, once again, we're just at this spike up in the amount of inventory sitting on the market. So active listings is anybody who listed 3 months ago and who listed 1 week ago that are still for sale today. And you can see the last since February, we've virtually been flat. And if we expand out this chart, so we're looking at 3 years of history. Let's just go look at the max. We can see it's always going up or down. And typically, we've got the low of February here, and it just goes up, up, up until August. And then we've got the low of February here, goes up, up, up until August. And that's a pretty solid trend to rely on. And this year, we just hit a low of February. We just deadlined it. We are not going anywhere for the amount of active listings on the market. So if we do see a spike in inventory, That's what makes me think, hey, we're going to have our typical 5 to 7% decline in prices from now until about November, roughly. It happens every single year. So if we can go back on this chart for closed price, and we can look, just pick a peak, and we can look, June was the high here at 360, and then boom, October the low, 342. The high was June, 385, and we went down to 367. It happens every single year. June was the high, and then we go down all the way until January. So it fluctuates by a couple of months, but that's a pretty cyclical event here, is prices kind of rolling up and down. More up than down, though. Now, going on to look at the number of pending listings. So once again, usually pending listings are just on a spike up. Now that is fairly normal for this year. We've had more and more properties go under contract, and we just about peak this time of year. We can see last year the peak was May. Year before that, peak was May. Year before that, peak was June. So we could go up a little bit more, but zooming out on this chart, we can see this is a very common trend out there. We peak in May, peak in April, May, June were the same, and then we drop off like a cliff for pending listings, which then correlates to closed listings, of course. 30 days later, people are actually closing on their properties versus getting them under contract. And so we can see the same trend here, where last month it was kind of goofy. We dropped in closed listings from March to April, which is not normal. So we had a few anomalies last month in their data. So I was really excited to see what was going to happen this month. This is what I thrive on. I love seeing the numbers to what is actually happening in the market versus just what all the headlines are telling me, because I know their data is months old that they're working with, and they're just trying to get clicks on their headlines, right? So we dropped in the amount of closed listings in April down to 5,800, and this month we went up to 6,600. What were we at 12 months ago? Well, 12 months ago was the very tippy top peak of the market, and we closed 8,500 properties. This year we're down to 6,600, so solid 25% down in closings. That's the headline you're going to see, but they're also not telling you that the amount of active listings on the market, we're at 9,600 versus May last year is at 8,800. So we're up actually a little bit in the amount of active listings, but yet the closed listings are down quite a bit. So we might actually be seeing an inventory imbalance happening. If we keep the same trend on active inventory or new listings coming out of the market, and our closings remain suppressed from last year, we're going to start to have more supply than we are demand. That's going to affect prices. Days in MLS, let's see, just dropping like a rock. Look at that spike. January was 35 days on the market on average, and come May, 7. Unbelievable. There have been multiple offer scenarios out there. I have seen properties selling at $50,000 to $100,000 over asking price, although it is few and far between, and it is not commonplace like we saw last year. A lot of stuff is going for 1% to 2% over asking price. That has been fairly normal as long as you're priced right. The people who are greedy out there that are still wanting to overprice their properties, they're sitting on the market for 30 plus days, and they're having to stair step their price down to catch up to the buyer's value in their minds. So if you're going to go on the market, price your property right. That's it. Month supply of inventory. All right, so here we go. We're creeping up a little bit, and this is what we were just talking about, right? Little bit of supply and demand issue, less closings happening than new listings hitting the market. But even then, we're still down in both categories so much that it's hard to get a real feel on things. But last month we had 1.6 months of inventory. This month, 1.7. So a little bit more inventory than there are buyers right now. Percentage of closed dollar to list dollar, meaning how much the properties actually closed for versus what they were put on the market for. We can see back in 2022, they were closing for 5% more than asking price, and then we dipped down, closing 1% under, and now we're just kind of at the 100% mark. Most properties are selling, balancing between the ones that have overpriced and have had to adjust, and balancing out the ones that are going for 50 grand over. They are closing at about at about asking price. Price per square foot, I don't really look at this because it doesn't mean anything. Dollar volume going up just like closings are. The more closings we have, the more volume in dollars we are selling. Shows to pending. Okay, so this is an interesting one. The amount of showings before a property goes under contract is dropping down to 9. So we were peaking out at about 12 showings per active listing in December and January. We're down to 9. What is this historically? Is this high? Is this low? And in the past, let's get rid of the last 2 years. Let's just get rid of those 2 years. I think we would all live a little bit happier if they just didn't exist. And we can see, 10, 11, 12 showings per going under contract is about the norm. So we are totally within the realm of what's normal. And then the amount of showings per listing is at 7.3. That's over the month. So if you're on the market and you're a little bit overpriced, even a touch overpriced scares away buyers. It's kind of fascinating what happens out there. And you're getting about 7.3 showings per month on your property if it's listed for a month. So there's a breakdown in the numbers on what's actually going on in the Denver real estate market. Now, I know a lot of these numbers are mimicked by what's happening nationwide, but certain states are getting hit a little bit more so specific cities like Austin is getting hit quite a bit more, Phoenix, San Francisco, Florida, the entire state now, they didn't have any correction really last year, and now they're starting to have a little bit of one. So, the market just does what it's going to do. There's not always a rhyme or reason to it. You just kind of got to go with the flow. Now, interest rates today, they're sitting at about 6.7% for your conventional loan. Now, that has creeped up over the last few months, which is interesting because the 10-year yield has not creeped up that much. And generally, we're within 2% of what the 10-year is to what mortgage loans are. The 10 years at about 3.7%, and we're sitting 3 points higher. Historically, we sit 2 points higher. So I actually think interest rates have the ability to go down. I really think the banks are just taking advantage of the situation, being that they came from such a suppressed interest rate market for so many years. I think they're taking advantage of it right now, to be honest with you, and it's going to take a while before those two balance out. And then something else I wanted to show you, which I don't often look at this because I'm just not in the commercial space. However, I heard through a little birdie, one of my buddies who's a commercial guy saying, hey, commercial might be a tipping point that affects the rest of the market. Okay, so we just had COVID. We just got through it. We had a lot of people start to go home to work. Now, a lot of those people didn't go back. Even if the number is 5% of the workforce that didn't go back into the office, that's still 5% less demand on needing commercial space. Then we, in general, have no workforce right now. The unemployment rate is at record lows. You can get a job anywhere starting at $20 an hour, it seems like. And so there just hasn't been as much demand for office/commercial type of space. Now, this chart that I'm showing you here is from Green Street Commercial Property, and they track what commercial prices have been doing. So we're looking at a chart here of the U.S. Commercial property price index, and we can see it peaked out at about 155. It's just an index number, and it's down to about 131. And so what this is saying is over the past 12 months, the values of commercial properties are actually down by 14% nationwide. That's pretty steep. Now we can go look at the European property price index, and the numbers are even crazier. So they're down 7% in the last 3 months, and they're down 21% over the last 12 months in commercial property values. And now we're starting to see a lot of headlines like this in the commercial space where the value on this building is actually less now than it was a decade ago. And so when you're running a business, you can actually do kind of organized defaults on your loans, which then kind of destabilize what's happening in the commercial market, and then it just kind of accelerates. Now, will that spill over into residential? that is yet to be seen. So there you have it. There's a quick breakdown of what the Denver metro real estate market is doing. So where do we go from here? Well, let's just go back to the trends. I think we take a 5 to 7% dip over the next few months if nothing changes, if our supply and demand kind of roughly stays the same. If we do see any blip in foreclosures, which we have started to see, but it's not enough to make any sort of a difference, then I think the amount of closings that are being suppressed can increase that number to maybe 10%, maybe 15 on more of a drastic take, but we're still up 50% than we were a couple of years ago. So if you're planning on being in your house for more than 5 years, totally. Go ahead, make the plunge, do your thing, make sure you can pay the monthly mortgage, make sure you're on a fixed rate loan. We have fixed rate loans here. A lot of other countries don't, i.e. Canada, for example. So you bought a house a couple years ago, 3% interest, you're now paying over 6%. That is a drastic difference. We have the advantage here of having fixed rate loans for our mortgages. So take advantage of it. If interest rates drop, go ahead and refi, but you're never going to be able to time the top. You're never going to be able to time the bottom, so don't ever try. But I'd love to hear from you. Give me a call, shoot me a text message, send me an email, like, subscribe, do all that good stuff if you think I'm giving you value. And if you are thinking of moving here from out of state, watch this video on the 15 top reasons why our Denver city might not be right for you.